Let's kick off today's explainer by tearing down one of the absolute biggest myths out there, the idea that you need a massive six-figure salary to build real wealth. You absolutely don't. Honestly, waiting around for some magic payday to finally take your finances seriously is just wasting your single greatest asset, which is time. Average income millionaires are out there, they're real, and they get there by running a highly specific, repeatable system. Just think about two different people for a second. First, you've got someone earning a pretty modest salary. They own a home, they've got actual savings sitting in the bank, and most importantly, they sleep perfectly fine at night. On the flip side, you have someone making triple that salary, but they're constantly stressed, maxed out, and quite literally one bad month away from total financial panic. The crucial takeaway here is that the difference between these two was never the size of their paycheck. It's all about the underlying machine they are running behind the scenes. The source material breaks this wealth machine down into four logical phases that we're going to explore. Phase 1 is laying the foundation. Phase 2 is multiplying your money. Phase 3 is protecting your wealth. And Phase 4 is playing the long game. Let's dive right into Phase 1, laying the foundation. Okay, before we can even think about multiplying your money, we have to build an absolute, non-negotiable baseline. This system completely flips the traditional financial script upside down. Because, let's be real, most people run their finances backwards. Their paycheck lands, they pay their bills, they do a little fun spending on the weekends, and then whatever miraculously survives the month gets tossed into savings. That is a guaranteed recipe for ending up with nothing. You've got to flip it. The exact moment your paycheck lands, 10 to 20% of that money needs to move out into a separate account before you can even touch it. Automate it. Just completely remove willpower from the equation. And whatever you do, don't fall into the trap of waiting for a good month to start this. There's no such thing as a good month. There's just the decision to start today with whatever percentage you can manage. Now, once you're actually paying yourself first, you have to confront the blind spot of small expenses. Your brain absolutely loves the quick dopamine hit of a coffee, but it conveniently forgets that you bought it, 350 times this year just to survive your morning meetings. That quietly evaporates into a massive $1,800 annual loss. So, how do we actually fix this? You track every single expense for just 1 month. Seriously, all of it down to the last cent. What most people find when they do this is deeply unsettling, but it's also incredibly powerful. Simply seeing the raw, undeniable math of your habits tends to cut unnecessary spending by 15 to 20% instantly. No strict budgeting spreadsheets, no immense willpower required, just cold, hard awareness. Moving on to Phase 2, multiplying your money. All right, now that we've laid the foundation and plugged those everyday leaks in your spending, it's time to play a little offense. First up, we need to reframe how you view your day job. A single paycheck isn't just an income. It is a single point of failure. And that's not just because you might get fired, but because your wealth can never realistically grow faster than your company's standard annual raises. This is where a second income stream changes the math entirely. Whether you're freelancing a skill you already have, tutoring, or selling stuff online, you need a secondary flow. But here is the real secret. The goal of this side hustle is absolutely not to make you rich on its own, and it is definitely not to fund a fancier lifestyle. The goal is for every single dollar of that second stream to feed straight into your investments as an untouched multiplier. Speaking of investments, let's look at two hypothetical friends. This perfectly illustrates the difference between just saving your money and building actual wealth. Both of these friends are super diligent. They both save $500 every single month for 20 years. But friend A, they just leave that money sitting in a traditional bank account, gathering dust. Friend B takes that exact same $500 and consistently drops it into a simple, broad market index fund. Prepare yourself, because this math is jaw-dropping. If you invest just $300 a month for 30 years at an average historical return of 10%, your portfolio will grow to over $600,000. But the craziest part? The amount you actually contributed out of your own pocket is only about $108,000. The entire rest of that balance is pure compound interest. That is quite literally your money making more money while you sleep. Saving protects what you have, sure, but investing is the only tool that actually multiplies it. Start small if you have to, but you have got to start. That brings us to Phase 3, protecting your wealth. A powerful engine is totally useless if it's leaking fuel all over the highway, right? The first major threat we have to neutralize is lifestyle inflation. It's such a sneaky trap because honestly, it feels like a well-deserved reward. You get a big raise at work, and almost instantly your expenses rise to match it. You upgrade your apartment, you lease a much nicer car, you start ordering more takeout. Suddenly, you're making more money than you ever have in your life, but somehow you are no wealthier than you were 3 years ago. The people who actually build lasting wealth do the exact opposite. When their income goes up, their savings and investing rate goes up, not their spending. The next layer of protection is your knowledge. Nobody is born inherently understanding compound interest or tax codes or credit utilization. It's a learned skill. And unfortunately, the cost of financial illiteracy is staggeringly high. Literally, one terrible auto loan, one completely missed tax strategy, or falling for one get-rich-quick scam can wipe out years of your careful saving. Treat financial education like a daily habit. Read books, listen to reputable financial explainers, and constantly keep learning. Knowledge is the armor that protects this entire system you're building. And then we have the ultimate wealth destroyer, high-interest debt sitting at 20 to 30%. If you're carrying a credit card balance at these kinds of interest rates, let me be very clear. No investment strategy on earth is going to out-earn that math. You could literally have the most perfectly balanced investment portfolio in the world, and you would still be losing money net every single month. It's the financial equivalent of frantically bailing water out of a boat that has a giant hole in the bottom. You have to fix the hole first. You must aggressively kill that high-interest debt. But here is the real masterstroke. Once it's gone, do not absorb that freed-up cash back into your daily spending. Redirect that exact same monthly payment straight into your investments. You won't even feel the shift in your lifestyle because that money was already leaving your checking account every month anyway. But now it's finally working for you instead of against you. Finally, we reach phase 4, playing the long game. This is where we learn to scale the system over the long haul. Let's be real for a second. We talked earlier about how a massive salary isn't required to start building wealth, but that absolutely does not mean you should ignore opportunities to increase your earning power. Combining these strict financial habits we've discussed with a higher income is unequivocally the fastest path to wealth. So, go build rare, highly valuable skills, get the certifications, and perhaps most importantly, foster genuine, real relationships in your industry, not just superficial networking. Opportunities very rarely arrive via some random online job board. They arrive through people who know, like, and trust you. All right, we have to talk about the part that, honestly, nobody really wants to hear. In our age of instant gratification, none of this happens quickly. True wealth building doesn't reward intensity, it rewards time. In year 1, you're just starting. By year 5, you've been disciplined, but honestly, it probably feels boring and painfully slow. There are definitely going to be days you'll wish you had just bought a fancy watch instead. But if you keep doing those boring, correct things long after the initial excitement wears off, you hit year 20. And that is when the compounding results become almost unbelievable. The source material leaves us with this incredible, powerful thought. Wealth isn't built on payday. It's built in the days after payday. Every single financial decision from this moment forward is either buying your future freedom or it's borrowing against it. The math is proven and it works. So ask yourself, are your habits today funding your future wealth or someone else's?